All right, welcome everyone to our home buying workshop. I'm Sarah. I'm Outreach Program Director at Denver Community Credit Union, and I will do our introduction to get us started. So some of you may be members of our credit union, some of you may be members of other credit unions and be very familiar with credit unions, but in case you're not, I always like to give a little overview because I didn't know what credit unions were for many years and how they were different, and they made such a big and positive difference in my financial well-being. So credit unions are cooperatives, they're not for profit, and their mission is to serve people, so people above profit. So profit is not the number one motive. As a cooperative, there are 7 cooperative principles, and you can see some of them here. Really, essentially, credit unions are owned by their members who decide how things are operated. They vote on the board of directors. Our board of directors are all volunteers and members themselves from our local community, and your money gets to stay local. And this is a high-level overview of how the credit union operates. So if I deposit money into the credit union, that money is used to lend to another member at a low rate. And then the profit from the loans is reinvested into the credit union and returned to everyone who's a part of the club, the credit union, if you will, in form of better rates and fewer fees. And then our credit union in particular, our mission is educate, deliver, achieve. We are very focused on financial education and connecting our members and community members to services that help them achieve their financial goals, not what we think other people's goals should be. We've had this financial education program since 2005. It includes live classes such as this one. We have e-learning courses as well. So if you're interested in credit or budgeting or a really short overview of home buying to share with someone, like 5 to 7 minutes long, not nearly as in-depth as we'll get today, those are all available on our website. And our credit union has served our community since 1934. So we were founded by City and County of Denver employees way back when. And then over the years, we've served more and more people. And now we serve all of the counties that touch Denver. So Denver, Arapahoe, Adams, and Jefferson counties. And as I mentioned, we are not for profit. And so my job, Sarah, that's my picture on the top, is to manage our outreach programs, which includes financial education. I manage our volunteering and giving programs as well. And then joining us today, the true expert on this topic is Irene Glazer, and I will allow her to introduce herself. Oh, I think you're muted, Irene.
That's right. Hi. How's everybody doing? I'm Irene. I'm with Compass Real Estate. I've been a realtor since 2001. So I've seen all kinds of markets, and I'm really excited to be here today and share all the information that I have about home ownership and answer any of your questions.
Great. Thank you so much, Irene. And so I want everyone who's joining us to feel free to ask questions in the chat. If you have a personal question, please email Irene or myself directly. JC is also joining us today. She's with the credit union, and she can answer any questions you have related to the credit union. Yeah, there she is. And she is our financial coach. So if you want to meet with JC one-on-one to help you reach your goal of becoming a homeowner, building up credit, coming up with a plan to save money, anything like that. She's kind of our resource navigator and a financial coach. And that's a free service that we offer. You can send JC messages or questions as well. Please don't put your member number or any sensitive information in the chat for everyone, because everyone may be able to see it. And with that, we'll go ahead and get started. So home buying. Buying a home is typically one of the largest purchases you'll ever make. And it's a big deal, and it's very rewarding. There are a lot of steps, but many of them are reassuring. So typically most people don't decide they're going to buy a house one day and then they have bought a house the next day. There are a lot of steps you go through. You meet with your lender, a mortgage loan officer who can answer a lot of your questions. You can meet with a mortgage loan officer before you're ready to apply for a mortgage, which is a loan to buy a home. I recommend that. And figure out if you have your ducks in a row, questions that you might have to help you prepare for the process. And of course, your realtor is a fantastic resource for all things home buying. They're very knowledgeable, have a lot of resources and connections typically when you have questions about different aspects of home buying. And you have time. So, you know, in this market in particular, you want to get pre-approved. We'll dive into that a little more later on, meaning you know how much you are eligible to borrow, and that gives you the opportunity to crunch numbers and make sure that the amount that you are willing to borrow to buy a home is in line with your budget and your goals and your values and your priorities, because owning a home is great, but most of us have other obligations as well on top of being a homeowner. So lots of steps along the way to help you feel prepared. And I see a question about this being recorded. Yes, it will be available. So we are recording this and we will put it on our YouTube page. Everyone who attends and everyone who was unable to make it, we will send a link to the video later on. Good question. Okay, and I'll pass it over to Irene.
All right. So, who's excited? And what excites you about being a homeowner? Can you guys drop it in the chat? Maybe a one word. What would it be like? And just, you know, why did you come today? What's exciting to you about becoming a homeowner? Drop a word in the chat for us. Yeah, owning a place of your own, someplace that is stable, that you don't have to keep moving. Maybe get to grow a garden, a safe space, exactly, retirement, yard for the dogs, and equity, exactly. Equity is huge, and home ownership is one of the best ways to gain appreciation and really help us close that wealth gap that exists. Go ahead and flip it, Sarah. So yeah, so some of the reasons that you guys mentioned are all here. Stability, you don't have to move all the time. You're not at the mercy of your lender. Things are more on your terms. Appreciation on the investment is huge, and that generational wealth that some of you mentioned. There's really no other investment that you can benefit from like home ownership with, you know, a down payment that's as little as 3%. A lot of times you are able to gain the equity. If you buy a stock, for example, you're only buying that amount that you are paying for, but with home ownership, you are putting down a small percentage of what that asset is really worth. And so then you're able to really capitalize on double-digit appreciation rates, which is what we've been having recently. And I'm sure you guys have heard Denver home prices, and just, you know, a quick numbers review, and we'll go into some more numbers later. The average sold price in 2007 was in the 300s. And right now for a detached single family, we're in the high sevens. And for attached, we're pushing 500,000. So it gives you a little bit of a glimpse as to how people have been able to gain that kind of appreciation and those kind of benefits with the equity. So don't get discouraged is going to be kind of my theme here, because even though home prices are high and interest rates are going up, there are still ways to buy and get into the housing market and be able to gain all of these benefits. There are tax benefits of ownership. As you might know, you get to deduct your property taxes and your interest on your loan. And then your rent won't keep going up, and you really have control of the property, and having your own little space and your own yard is always really a great thing and something to be really proud of. So I'm glad that you guys are all here, and this is the first step, and just gaining some knowledge and hopefully bringing you onto the road of home ownership. So with that, as far as the differences between renting and owning, I'm sure you guys probably know some of these. When you're renting, of course, you call your landlord, they fix things. When you're an owner, things are more on you. So with that ownership, comes high reward and high responsibility as well. With rent, you don't have to pay property taxes or homeowners insurance. When you own, you do pay those things, but like I mentioned, property taxes are deductible, and so is the interest on your loan, which is a big benefit of owning. When you rent, you don't have those maintenance costs, and then when you own, you do. But hopefully we can help you mitigate those expenses as you're in the process. Also, renting is expensive, and I know that home ownership is expensive right now, especially in Denver Metro. But with rents, I think on average we're at $1,700 a month. And maybe drop in the chat, what are you guys paying? Those of you that are renting, if you don't mind, I'm curious to know what you're paying a month. If you're paying around, I see 3,000. If you're paying, the 1,700, that's $20,000 a year. After over 5 years, it's $102,000 that you don't even have anything to show for. So with home ownership, like I mentioned before, you've got that small investment that then continues to grow for you. And so it's just a really, really good first step.
Yeah, thank you. And yeah, I mean, we have these, renting versus owning. It also depends on your landlord. I will say, as I looked at this, I'm like, I've had some great landlords that fix things in a timely manner. And I've also had landlords where there was my roof leaked for 3 months. There was one point in a rental where I couldn't use my shower for a month, which was not great. The only shower in the rental, I might add. So yeah, I had to go to a friend's house on my way to work every morning, on my walk into the credit union to use their shower. That was not ideal. So yeah, while there are responsibilities with home ownership, renting, I think most of us have had the experience of some not so positive aspects too.
Yeah, and hopefully that's going to be changing a little bit these days with Denver passing some new legislation around renters' rights and things like that. But rental rates are going up, just in step with appreciation rates. So renters are going to be experiencing double-digit increases in rent as well. So
yeah,
it's important to try to get in sooner rather than later. My favorite thing to say is that the best time to buy a home is yesterday, and the second best time is today. So just, try to get on that path. So some things that you could ask yourself as far as home ownership, is it the right time for you right now? Do you have that home ownership mindset? Do you see the value in it? Determine what you can afford. Do some budgeting and figure out what your monthly expenses currently are so that you can figure out what your monthly payment that you can do. And it sometimes will be more than what you pay in rent, but keep in mind, then you get the tax benefit of home ownership, and that you can recoup that in your monthly income if you change your employer withholdings and things like that. And then get pre-approved. Go talk with a lender. And Denver Community Credit Union is a great place to start. They've got licensed loan officers that can get you pre-approved and talk to you about your options. Down payment, that can be daunting for first-time buyers, and keep in mind that can be a gift. And there are also programs that are available to you to help with down payment. And hopefully there's going to be some government programs coming down the line, especially for first-time home buyers, because we have had those in the past. And with what our prices are today and what interest rates are going up to, I can't see that is not going to be a factor. So I think there are going to be some down payment assistance programs coming. So selecting your lender and your real estate agent, those are going to be your partners throughout the process. So really do some due diligence on that and get your partners in line and work with people that you jive with, that are trustworthy, that have all the skills that you need in order to get to the finish line in this process, because I know it can be daunting at times. Next one. How much home you can afford. That's you, sir.
All right. So a big part of home ownership, of course, is making sure that you know, feel ready financially and otherwise. Before I jump in, we did get a question, Irene. What should we expect as a rate for a realtor? I think they're asking like what is the compensation typically like for a realtor?
It's a good question. I'll go into it a little bit later, but as a home buyer, typically the expense of having a realtor is a seller cost. So I'll go into it a little bit more later because there's exceptions to that rule. But 99% of the time, having a realtor working for you as your buyer's agent is a cost that is paid for by the seller.
Yep. And that was my experience buying. The seller paid my realtor. I did not pay out of pocket for a realtor. Thanks, Irene. So thinking about housing expenses that you're going to have, typically, you know, you'll hear to try to not have your housing costs exceed 35% of your monthly gross income. So gross income is before taxes, health insurance, retirement savings, all of that gets taken out. I will say, you know, it really depends on where you live, right? So it's probably pretty easy to not exceed that in North Dakota or parts of Wyoming, Kansas, a little harder in Denver Metro, but that's something to just keep in mind as a guideline. And the payment that you're going to be making towards your mortgage does not necessarily include some other costs that you may have. Such as a homeowners association dues. So I used to think that HOA dues were only for condos, but they can exist with townhomes, certain neighborhoods that have amenities like pools and yeah, just certain neighborhoods have HOAs for these detached properties, single family homes as well. PMI is private mortgage insurance. So if my down payment is less than 20% at the time that I apply for a mortgage or purchase my home, I will pay private mortgage insurance. It is different than homeowners insurance. So homeowners insurance, think of it as protecting the structure. If anything happens to your home, there's a fire or hail on your roof, that kind of thing. Private mortgage insurance is insurance for the lender in case you default, meaning you don't pay back your loan. So it is an added expense that exists. The good news is that with most mortgages, and we'll talk about this a little later on, you can get rid of that PMI, the private mortgage insurance, once you have 20% equity of your house. So that could be by making your mortgage payments. And it could also be because the cost, the value of your house is appreciated. So, and that can happen pretty quickly in Metro Denver because housing appreciates pretty quickly. I bought my first home last February and I was looking at the value and I was like, oh, wow, like I'm almost close to hitting the 20% down and being able to get rid of my private mortgage insurance, which was faster than I expected, but wonderful, wonderful news. So I'll be looking into that soon. Did you have anything to add, Irene?
Yes. So, and also just like we were saying with things being tax deductible for you, that private mortgage insurance is also a tax deduction. So
it is.
That can be a real good benefit of home ownership. With conventional loans, you can get that removed once you're at 20% equity. And like Sarah mentioned, it happens pretty quickly in the Denver market these days. And but with FHA loans, which your mortgage lender will be able to go into the differences of what conventional versus FHA versus VA financing
Mhm.
might look like for you. But with FHA, you can't delete that
Mhm.
PMI, so you would have to refinance. But
Exactly. And we will talk about FHA loans a little later. Okay, so here's an example. So if a household earns $50,000 a year, we divide that by 12 to get the monthly gross income, multiply it by 0.35, so that's 35% of their income. And you can see spending that would bring them to about a little over $1,400 a month in housing costs. So we talked about the average rent, what that's like lately. I wanted to use an example because let's say this is a household of one, right? So there might be multiple earners. Just wanted to give an example. Everyone's salary is probably a little different on this call, but you can see what that looks like based on people's salary. These are all just examples. And then how that translates into buying a home. So let's say that a home sells for $450,000. A down payment of 5% is about $22,500. So some conventional mortgages, and when we say conventional, it means through a credit union or a bank, typical lender. Most of those mortgage minimums are 5%. Sometimes you'll find programs that are 3% down. When you put less down, such as 3% versus 5%, it might increase the rate you pay in interest depending on the lender. So that's something to keep in mind, but there are programs, and we'll talk a little more about down payment assistance programs in the Metro Denver area as well. So what this would look like with a rate of interest rate, APR is annual percentage rate of 5.25. The monthly payment would be a little over $3,200 a month. And the mortgage itself would be $427,500 because you're not taking out a loan for the amount of the down payment. On top of that, you would add property taxes, insurance, so insuring the structure, as well as that PMI, private mortgage insurance, HOA, homeowners association dues, if applicable, to the total housing costs. And ideally, total housing costs and any other existing debt obligations that you already have would be less than 43% of gross income. Different lenders have different caps. So they will look at credit, they will look at, if how much my student loan payments are per month, and credit cards and auto loans, and any outstanding debt that I have regular on-time payment or regular payments due for, those are taken into account. So saving for a down payment is fantastic, and focusing on keeping your debt manageable and other aspects beyond homeownership is also really helpful, because some people might find themselves in a situation where they're not able to borrow as much as they need to purchase a home because they're extended on debt and other aspects. And as Irene mentioned, there are special home buying programs for first-time home buyers, including FHA, VA loans, and adjustable rate mortgages, which we'll get into a little later. As I mentioned, putting 20% down avoids that private mortgage insurance, but that can be really daunting. That's a lot of money, especially for a first-time home buyer who hasn't built that equity or sold another home and has the profits from that. It is unusual for most first-time home buyers, and you can see what it looks like. So if going back to that example that we had, $450,000 home value would be $90,000 down. And gifts are typically accepted, and that's fantastic if you have someone who's willing to give you a gift. I did not. I had to really just, save for years and years, and make that a priority. And that's something that JC helps a lot with. The financial coaching we do at the credit union really focuses on helping people achieve their goals in a way that's in line with their values and their priorities. And for me, becoming a homeowner was more of a priority than going out to brunch every weekend. I love a good brunch, but I'm a homeowner now, and that's fantastic. And that required, shifting my priorities and my spending a little bit and get to where I want to be. And it was worth it in the long run, for sure. let's see. And now we will talk a little about different home buying loan options. So those conventional mortgages, so these are underwritten and insured by private lenders and investors, as opposed to the federal government, which would be an FHA loan. So down payments can be as low as 3%, typically 5% minimum is a little more common. There's no mortgage insurance PMI for down payments 20% or higher, as Irene and I mentioned earlier. You can get rid of that PMI, private mortgage insurance, later when you have 20% equity, and that can be making payments as well as the value of your home increasing. Borrowers with high credit scores and good down payments typically benefit the most from these types of loans. And they're the most common types of mortgages most people have. Some government loans can include additional fees and mortgage insurance requirements that conventional loans don't. So that's something worth knowing and noting, is that it's definitely worth shopping around for your mortgage. I did that. I looked at different credit unions, banks, companies that offered only mortgages, like online types of companies. And a credit union mortgage was the most affordable. So that's what I went with, but I still did my due diligence and looked around, because it's a big loan, right? And you want to make sure. What's important to know is that APR, annual percentage rate, includes those fees. So that's an apples to apples comparison. If you only look at the interest rate, that's not going to tell you the true cost of a loan, because sometimes an interest rate looks really low and you'll see it advertised and you're like, oh, 2.5% interest, that's fantastic. And then all the fees get added and it's like a 6% loan. So it's a good idea to look at the APR to try to compare them. And have a better sense of what the cost will be. And there are fantastic calculators that you can find online. There's some on our website as well, where you can punch in, okay, if I buy a home at this value, and this is my down payment, and this is my rate, this is what my monthly payment would be. So playing around with some of those can be really helpful too. And requirements for these loans typically can be stricter in some ways, because they're not backed by the federal government like an FHA loan. The lender itself is on the hook if somebody does not repay the loan. So it's a bigger risk. So that just means that there might be, credit score requirements might be a little higher, not necessarily always the case relative to FHA loans, but that can be the case depending on the lender. So speaking of FHA loans, and we keep saying FHA, there's so much jargon in financial services. FHA is Federal Housing Administration, but you'll never really hear anyone call it that. It's always an FHA loan, because that is a mouthful to say. Most loans are limited and they vary by county. So you'll see that in Denver County, the max is over $684,000. If you were looking at a county in a more rural community in a different state, it would probably be a lot less, and that's for a single family home. Upfront mortgage insurance is required, and it's typically 1% of the cost of the loan, and you can't get rid of it. So the only way to get rid of it would be to refinance, meaning you get a new loan to pay off that loan. So even if you hit 20% equity later on, you're still paying that extra expense, which is why people who will get this loan sometimes will get it and then they will refinance it later. It's non-cancelable is the term. And the borrower is not required to be a first-time home buyer, but must have not owned a home in the last 3 years. Gifts and grants are allowed, and non-occupant co-borrowers are allowed, which is a wordy way, jargony way of saying that if you don't live there, you're not an occupant, you are still allowed to be a co-borrower. You can co-sign on the loan. And that's allowed. So some mortgages do not allow that. FHA does. So that means, let's say that I wanted to get an FHA loan. I did not have very good credit, and that I needed a co-borrower to help me qualify. That would be a route that I could take. Some of the benefits are low down payments. So 3.5% down, may be able to buy more house, and can be used for purchasing and refinancing. And again, that 3.5% can mean putting a lower down payment down so you can borrow more, but more and more conventional mortgages now allow 3% down. And I see some questions have popped in, so let me take a moment to glance at those. What credit score is used if a couple is applying? Is an average of the two? Fantastic question. I learned this myself. So they don't average them. They pull all 3 credit scores. So there are 3 credit bureaus, Experian, Equifax, TransUnion, and a mortgage lender will use your FICO score. So that is a company and a proprietary model that they have. They will pull those 3 scores for each of you. And then they will take the middle one for each of you, not the highest, not the lowest, the middle. And then between those 2 middles, they will take the lower one. That's how it works. Yeah, I wish they would just go with the higher one. It became like a competition with my husband, and I beat him by a couple points. I was very excited. I do also help people build up their credit, but he doesn't always like to listen to my advice because I'm his wife when it comes to credit. So yeah, I was excited that I beat him by a couple points, but we went with his, which was still an excellent credit score. But yeah, good question. Another question is there someone who can help with saving for a down payment? Yes. So if you could send your email address to JC, we will have a mortgage loan officer reach out to you, or you can send it directly to me. Good questions. Okay. VA loans. So VA stands for Veterans Affairs. So VA loans, to qualify, a veteran has served 90 consecutive days during wartime or 180 days during peacetime or 6 years in the reserves. They're able to purchase a home with no money down and no mortgage insurance requirements, which is fantastic. And can be really an excellent opportunity for US military veterans. They do tend to have stricter requirements on the types of homes you can buy. So it needs to be in good shape, habitable, not somewhere that needs work to just be a place that's livable. I'll give you an example. I looked at a house where it was fixer upper, I think, was generous. It did not have working plumbing. There were no toilets. We were joking, we're like, oh, well, this isn't our price range, but what are you supposed to do when you move in? So yeah, it needs to meet certain minimum property requirements. So that's the kind of fixer-upper I'm talking about, not just a property where, oh, it'd be nice to update the kitchen or the gas range is, dated. It's real work that needs to be done for it to be livable. And a great local resource is CHFA, the Colorado Housing and Finance Authority, that serves the entire state. They do have some homebuyer workshops. So if you are considering getting an FHA loan, there is an education requirement. The workshops are long, so a lot more in depth than this. They're available in English and Spanish, and to get that education certificate, you can do it online or in person. They have a calendar on their website where you can see those. I think the last couple I went to were around 6 hours. I went on a Saturday, very, very comprehensive, and a requirement for certain types of loans. They also have grants and or loans, depending on your situation, for down payments and closing cost assistance. Some of them are grants, meaning you do not have to repay them. Some of them are loans, and the loan repayment is due upon the sale of your house. So you don't have to repay it unless you sell the house. They also have lower income rental housing, foreclosure prevention resources, lots of great resources. And yeah, the thing with home ownership resources like this, grants, down payment assistance, is funding will come in and then it gets depleted, it gets all used up, and then you have to wait. So I would always check on what's available out there. Another really great resource is Colorado Housing Connects. They have a website or a hotline that you can call, and they're knowledgeable about all the local nonprofits that have funds for down payment or closing cost assistance, who actually has the funds right now, where there are waiting periods. So really good resources, including if you're having a dispute with your landlord. I wish I knew about this. My landlords were all really nice, so I kind of just let them not be great landlords sometimes. But if you're having a dispute or you need help avoiding eviction, all those types of resources, fair housing, if you've been discriminated against in the home buying or rental process, there are resources available to you. Okay, I'm gonna pause and look at a couple of questions that came in while I was speaking. Okay, so some people want to do financial coaching. Awesome. Okay, so a question we received are, how many years should you spend in a house to make it worth it or not to lose money? That's a really great question. And this is coming from someone who's not sure they're going to stay in Denver for the next few years. I can answer it, but I think Irene is more of an expert on this.
Well, with the way that our housing market has been appreciating, which has been double digits as of the last couple of years.
It's about.
Someone's not muted. Is, you know, you really don't have to stay that long in a house in order to gain that appreciation and make it worthwhile. So, and if you think that you might be due for a job transfer out of state or something like that, you know, the one thing about buying a house as your principal residence is your intention needs to be living in that house for a minimum of 2 years in order for it to be your primary residence, so that if you sell after that 2-year mark, then you're not hit with capital gains tax. However, that's just, you know, that is a rule and there's ways around it. So it really just has to be your intention to stay there for the 2 years. So that's kind of the gauge. I think that, you know, in our Denver market and how desirable it is and how, and the lack of inventory that we have here, I think that it serves to your benefit to buy a home versus rent, pretty much in every situation, even if you think that, you know, within a couple of years you might be transferred out of state or something like that. And also talking about that whole wealth building component of home ownership, if, you know, everyone is living with uncertainty always. So if, for example, you do get job transferred, perhaps you could rent that home for a while and be living in a different city as well. So I hope that helps.
All right, thank you, Irene. So some good tips to consider when you're going through the mortgage process. Keep in constant contact with your lender. So not constant, but in regular contact frequently. The home buying process can take some time. So for me, it took years, partly because I was very picky and not very realistic at the beginning about how I could actually afford to buy. I wanted, you know, everything at a very low cost that is a magical house that didn't exist. But keeping in touch with my lender was really important because every, you know, 90 days, I needed to provide updated pay stubs and information to keep my mortgage pre-approval valid. So after a certain amount of days, you need to provide updated documentation and that kind of thing. And that's really helpful. If we were going to put an offer on a house, of course, you want to contact your lender, make sure your pre-approval letter is correct and updated. If you know, get a pay raise at work, that's fantastic. Update your lender. That might change the amount that you're pre-approved for. So sending those stubs, information throughout the process and get them to them in a timely manner, that's really important. You don't want your deal to fall through because your mortgage pre-approval lapsed So I just would put a reminder on my calendar and on my phone to pop up every however many days. And keeping in touch with your realtor, of course, is really, really important too, because they really are knowledgeable about the contracts that you're using to, put offers in, and might need things from your realtor for the other party. Really, really important to make sure that you're always on the same page. Some things to avoid are incurring new debt. So I do not recommend taking out loans or opening credit cards that you don't absolutely have an emergency need for when you're in the process of buying a home. It can really impact your credit score, which means you might pay more for your mortgage, and it can decrease the amount that you are eligible to borrow. So your pre-approval may no longer be valid. I've seen this happen before. Years ago, I did financial coaching with someone who was under contract, very, very end of the process of buying, and went out to a furniture store, opened a credit card, and spent like $15,000 on furniture. And then they no longer qualified for their mortgage at the same dollar amount, and the deal fell through. So please, please be very cautious about taking out new debt. Sometimes things happen, right? Like unfortunate things like a car is totaled and you need it for work. Those things do happen sometimes, and that's okay. But just make sure that you are cautious, aware, and just know that those decisions can impact that. So talk about it with your mortgage lender and your realtor before you make any sudden moves. Avoid changing jobs. And this should really say like occupations, right? So let's say that you are a teacher and you got a new teacher position somewhere else. That's okay. If you are have always been an English teacher, and then you are going to resign and suddenly become a basket weaver, you would need 2 years of employment history. Same with, for me, I have worked in nonprofits and credit unions and education and outreach. If I suddenly decided I was a welder, my lender would have been like, well, you don't have any job history as a welder, so you need to show us that you can, have sufficient income for 2 years in welding. I know nothing about welding, so I can't take that example any further than I have. But I hope that helps to kind of clarify that you can change jobs, roles. You get a promotion within your company, or you get a job doing similar work that you do at a new company and you earn more. That's fantastic, but don't do a complete career change. Is that an accurate way of explaining that, Irene?
Yes.
Yeah.
Underwater basket weaving has always been my dream job. So
yeah, well, there's still time, Irene. And again, making changes to your credit that could impact your loan. So that could be something as simple as credit utilization. So what percentage of the limit are you using on your credit cards? If you've kept your limits pretty low, 10%, 30% or less are definitely ideal for the highest credit score possible. Highest credit score possible, 10% or less of your limit. The credit bureaus look at what is the highest amount that you charge at any given point in a month. So keep it low. You can pay it off as many times as you want throughout the month. Keep it active so that it builds your credit. You can go up to 30% if you're happy with your score and where you are. That's great. But let's say you're doing that, and then all of a sudden you're getting to 90% of the limit on your credit card, or 60%, and you've kept it lower than that. That will drop your credit score. If you're making those changes in the balances that you're putting on your credit card. So just be very, very conscious of that. You can set up alerts. I highly recommend that. I have alerts that pop in when I hit a certain dollar amount on any of my cards. And that alerts me to, oh, I need to pay this down, or there might be some fraud on my card. So either way, it's good to keep an eye on. Just checking some questions that may have come in. So someone has a friend who purchased a house without their partner on the loan. They did that because they can enjoy the benefits of an FHA loan and first-time home buyer benefits. Is this a real or good strategy? I'm not sure. I have seen situations where one partner has really not great credit. A lot of collection accounts, is not credit worthy enough to qualify for any type of mortgage, and the other partner will do the mortgage by themselves because otherwise they would not qualify for a mortgage. So that can be an alternative. If you're using two incomes, typically you're going to qualify for more, a higher pre-approval amount than on a single income, right? So it really depends on the reasoning. An FHA loan, it may have been the case that their partner had owned a house in the past 3 years, the other hadn't, and that's why they went that route. So different people, I think, have different reasons for choosing to put a partner on a loan or not. Some people don't put a partner on a loan because if a relationship doesn't work out, you're both on the hook. So if two names are on a mortgage, if your relationship ends, whether it's a partner or you have a co-signer who's a parent or friend or relative, if one person stops paying the mortgage, the entire responsibility also lies with the other person. So it is a big responsibility. I was more nervous to sign a mortgage than I was to get married, to be completely honest with you, because I felt like ending a marriage just seems simpler than walking away from, having a sudden mortgage obligation that's 100% yours instead of 50% yours. Do you have anything to add to that, Irene?
Nope. It's really true. Choose your partners carefully.
Very carefully, and your co-borrowers maybe even more carefully, because they can be harder to get rid of than a partner. Irene's going to talk about the forecasting. Great questions today. Some other costs that will come up with buying a home are closing costs. So those can be about 2% of purchase price, not including prepaids. Prepaids, I find confusing. I think a lot of people do too. You are able to, with some lenders, pay money to reduce your interest rate through the form of points. And then it makes it really hard to compare the cost of one mortgage to another mortgage because that's not factored into the APR, the annual percentage rate. So that is to say that 2% of the purchase price. Our credit union does not do points or prepaids. We want to make things as transparent and easy to understand as possible. The buyer will have certain costs. The seller will have certain costs. So the buyer will pay for the appraisal. So what is the value of the home? The lender will not just take our word for what we think the house is worth. So a professional appraiser will go out there. The lender orders the appraisal. Typically, they don't pick one. It's kind of a lottery system to keep it fair so that it's not biased for the lender or for the borrower. And that way I'm not hiring my cousin Ed to, lower or increase the appraisal value. I have no control over who does the appraisal. The inspector goes in. You get to hire whatever inspector you would like. Highly recommend doing an inspection. I know in this market, some people skip it, but I think it's worth doing for sure. The down payment you're responsible for as a buyer, earnest money as well. So earnest money ends up going toward the down payment, and earnest money means it's money that you put down when you go under contract to show that you're serious, that you have some skin in the game, that you're not going to just go under contract and then change your mind later and then bail. There are reasons that you can get out of a contract to buy a home. So let's say there's some major health and safety things that come up during inspection, and they're deal breakers for you. You can walk away and typically get your earnest money back. But all of that is written very carefully into your contract. So you want to read that and understand that. And that's another wonderful thing about a realtor is they can explain all of that technical language and contract to you so that you know exactly what you're getting into and what your options are if something happens and you need to get out of the deal. The buyer typically does not pay their realtor. The seller also has title insurance that they typically pay for, and typically it's all realtor fees, which are usually about 6%. Now, Irene is the realtor, so I'll let her talk more about that a little later. But typically the buyer's agent is paid 3%, the seller's agent is paid 3%. There are some services where you're kind of going through a company, not an individual, and they claim to have fewer fees. So there are some hybrid models out there. Both the buyer and the seller will pay closing fees. And then other fees may exist depending on the home. So there may be HOA transfer fees to transfer it from the seller to the buyer. Depending on where you buy, there might be flood insurance. I actually saw some properties in Denver that I was surprised to see were in flood zones. Who knew that those existed in Denver? I did not at the time. Let's see, some questions have come in. Let's see.
Yeah, Sarah, I'll say as far as inspections go, yes, it's very competitive out there, and there are some buyers that are, waiving inspections on their contracts. I never recommend that, and especially for first-time home buyers, I would not. We can still be successful in winning an offer. There are different offer strategies that we can use and not completely waive inspection. So I would never recommend doing that, even in this very competitive market. What else?
And while Irene's reading the next question, I'll add, it was very, very competitive for us. I mean, I don't even want to say how many offers we put in over the year. It was a lot. And the way that we worded our contract was that we would do the inspection, but we would only object to things that were major health and safety. So any inspection is going to come up with issues, and some are really minor and some are a big deal. Like you need an entire sewer line replaced, which could be $30,000, right? So you're able to word things and still get an inspection in. Yes, there are people who do that, but I mean, that is a huge gamble, to Irene's point. Not one that I was personally willing to make. But yeah, I think a lot of people, they say they're waiving inspection, but really they're waiving ending the contract over really small things.
Yeah. All right.
Okay. You want to cover this one, Irene?
Sure. Getting pre-approved is really just of utmost importance, and you can't really be house shopping or putting in any offers without having that pre-approval letter from your lender. So make sure that you take all of those steps and get a lender, get your realtor, get your team together before you even start looking. So I think we're running a little bit late on time, are we, Sarah? Are we done in a few here? I don't want to keep any.
Yeah, we're done fairly soon, I think. We've had some great questions along the way, and I wanted to answer them as they were asked. But yeah, let's skip forward.
Yeah. So yeah, I'll just go through my slides really quickly because I want to save some time to go through the numbers and the condition of the market, because I know that's going to be of utmost concern for you guys. So as far as, talking about steps, this is one of the slides that goes over determining what your housing priorities are, making sure you choose your agent, and your realtor and your lender really are your team, and that only then will you go and view houses and then make offers and then work on negotiating inspections, appraisals, and everything on that contract is a deadline that your realtor will be able to help you with, and moving on to closing day. So next one, about choosing your agent and what realtors do. I think everyone kind of knows that, but if you have any questions, feel free to reach out, email me, and you should have some good resources in your guide that, Sarah, do you email those out to people so that you have good questions to ask your realtor?
Yeah, we do. So we'll send a resource email that includes access to a resource guide, and there's some great questions in there for interviewing an agent. So I interviewed several, and I mean, there's just some really important things that I wouldn't have thought of. Making sure that your schedules are compatible. If you're only available to look at houses on the weekends and after work weekdays, and your agent is not available then that might not be a compatible match. And just, yeah, there's some great tips in there. So we will send those out.
Okay. And then setting your housing priorities. There's a sample packet in your packet, just determining your must-haves and like-to-haves. Just really, in this market, try to keep it really broad. So, just having a toilet and shower, if that that would be great. But it is about making compromises and keeping in mind that this first time home is really just your stepping stone into being able to gain the appreciation and hopefully for your next home, and really make it your own and then be able to gain that appreciation.
Yep. Well said.
Yeah. And then, going out, viewing the houses, making sure that we consider your location and your lifestyle. A home isn't just about number of beds and baths. It's really, how do you live? What is most important to you? Do you like to entertain? Is outdoor space important to you? These are all questions that your realtor will be able to help you and narrow down. And then as we go out to look at houses, being able to point out any kind of red flags or things to consider. And also, with the market the way it is, are you going to look at places just as they come on, because it is so tight and the inventory is so tight. But if your budget is also really tight, do we then wait to see if a house makes it past the first weekend? And that's when we might go looking at that at houses if your budget is a little bit more limited than other people's. Next, so this is kind of more of the process, and after your offer is accepted, you are going to owe earnest money. Usually that earnest money is between 1% and 2% of the purchase price. So making sure that you have that amount as a check or a wire transfer that the title company then holds, and it gets applied to your down payment. So making sure you have that amount sitting in a bank account that you have full access to. And then when we write that offer, there's going to be deadlines in the contract, and then there's contingencies within the contract. And the contract is very much skewed towards the buyer. So we in Colorado are very lucky that way, where you do still have most of the time your inspection objection, and you're able to hire that general house inspector, sewer inspector, do a radon or any structural inspections. And that usually happens within the first 10 days of going under contract, at which point you might negotiate any inspection items. And then the contract is contingent upon you getting an appraisal. The appraiser is hired by your lender, and it is required if you're getting a loan. Getting a question about radon, and that you've heard it's sort of a scam. How concerned should a buyer be to get that checked? It depends. I think that you got to do your own research when it comes to health and safety type issues, and your realtor will be able to give their opinions, but really it is going to be about the buyer determining their own level of risk tolerance. Radon is a naturally occurring gas that's found typically below grade. So if you have living space in a basement, is when you would typically want to test for it. Of course, it's our job to mitigate your risks. So we always recommend that you do get that radon test, but ultimately it is your decision. So the other thing is, going through the whole timeline, is the appraisal is going to be very tricky in this market, because you are going to be competing against cash buyers or people who have additional monies to bring, because a lot of times in this market, houses are not appraising for value, because especially during this time right now is when in Denver we gain most of our appreciation, from really February through the month of May. So appraisals are not keeping up because they're using comparables of homes that have sold last fall. So that's something else to keep in mind as you're saving for a down payment. You may have to come up with an appraisal gap, and hopefully your realtor can help you mitigate those risks and talk you through what it takes and how to restructure loans and things like that, so that you're not having to come up with a whole bunch of extra money on an appraisal if that comes up short. So I know it's kind of a lot, and it's it can be a little bit daunting for especially first-time home buyers, but that's why as realtors and as lenders, it is our job to try to mitigate your risks and really keep you informed and give you those worst case scenarios so that you can be comfortable and decide what's right for you and look out for your best interests. Closing, we just meet at the title company, sign all the papers, and you're on your way. Possession is usually same day, especially if it's especially if it's a vacant property. But sometimes if the property isn't vacant and the seller may need some time to move out, that is all negotiated and part of the contract as we're writing it. So I want to go through really quickly the market stats. You'll see it here. In March, our sold listings were 4,650. We had 6,200 new listing. Average days on market was only 13, and we are at a sales price of about 700,000 right now, which is a 21% increase from last year. So that's why it really is of utmost importance. As far as future growth in Denver, the talk is it's not going to go down. So I don't think the appreciation is going to keep at this kind of pace. Hopefully we'll be at a more moderate pace of, on average, Denver is at 6%, but we've been around the double digits since around 2012 when we started coming out of the recession. So obviously that's not sustainable, and we'd like to see it at a more regular pace of like 6%, 3%. But the problem is the supply and demand. It's just the supply problem. Right now, right before this call, when I did a search in the 7 metro counties, we're at about 2607 actually listings in the 7 counties in the metro area. And just to give you a little bit of perspective, in 2007, we had 24,000 listings. 2010, 17,000 listings. So that's where our problem is just, it's really a supply problem. Builders are not building like they need to be in order to keep up with this demand. And I don't see that really changing from anything that the experts are telling us. So that's why I always say the sooner that you can do this, the better. But, save for your down payments. If you have the resources and are able to get some help with down payments or work with those down payment assistance programs, do that as soon as possible. So right now, our actives are going up a little bit. We're up 17% from last year for the month of March, which is great. So I think the listings are going up, and the close, they really just stay steady at like 3,400 properties that have closed. And so that is, just to give you guys a little bit of hope that, people are still buying houses, and even though it's really, really challenging out there, that doesn't mean that that's not something that you should just forget about because it's not a possibility for you. So really start talking to the experts and your realtors and get yourself started down the path of home ownership. I think that's really, really important. I hope I've answered some questions there. I have a couple of things that I can also send out. JC, I don't know if you want to pull that up or if you just want to send it out to people. I just wanted to kind of show those metrics with what's happening, or we can also send it because I know that we're running really short on time. Okay, there you
go. See my screen here?
Yep, got it. Yeah, if you can make it a little bit bigger. Yeah, and like I said, we can definitely send it out. But yeah, so we've got 1,300 active homes. So like I said, it was a 17% increase. Then you've got what's pending. 3,000 homes are pending and 3,400 have closed. Close to list price ratio on there, you can see that most of the homes are closing at about a 6 to 7% over asking price. And that's for detached single family. And then the attached market is about 106%. So just keep that in mind, that the asking price isn't actually the price. So when you're shopping for a home, make sure that you're shopping well below what you're qualified for, so that in case you do get into a bidding war, which is going to be very typical in this market, that you do have some wiggle room to go up. So, just really be cognizant of that. And I know people get discouraged and they want to say, I'm not into a bidding war, I don't want to do this. So that really just means you can't really buy in this type of market, because that's really pretty much 100% of what we're experiencing right now. And it's okay, because you're going to lose a lot of them, and you just keep going. And it could take quite a few offers, or you could get really lucky and have your first offer come through. And then we've also, got people right now that we're working with where they're under contract because their backup offer came in. So don't get discouraged, is my bottom line. So I know we're running a little bit short on time. Do you guys want to go to some questions? And feel free to raise your hand or just chime in, or if you want to ask something on chat. This is JC, flip to the next one. This is a good graphic that shows month supply of inventory. So you can see that in the lower price points is when we have the lowest supply of inventory. So less than a month. And so most homes are going under contract within that first weekend out. 11 days is our average days on the market. And really, it's within that first weekend in the lower first-time home buyer price points. So, and then that's for single-family detached. For attached, it's even more competitive, because the lower price point markets are really where we're very much lacking the inventory. So what else? What other questions do you guys have? Anybody want to pop out of mute and let us know? Yeah, a market balance would be if we had a 6-month supply of inventory. And in Denver, actually, it's about 4 months, but being below that 1 month is really tough for people right now. So,
and if you have questions later too, feel free to reach out to Irene or myself. We're happy to help.
Definitely. One thing I do want to say about interest rates too is that while they're going up right now, and they're much higher than they were last year, we're over 5% right now, which I know is tough for people. That's just the way it is, and we're going to be probably hitting a recession point here. So people that are locking in at that higher rate and buying their home right now, and that payment is going to be a lot tougher for people than it was just a year ago. We know that the way the market cycles work, that more than likely they're going to go back down, because we will have probably hit a recession at some point. And so then the government will lower interest rates. All those people will start refinancing. Or refinancing is really a cool thing as a homeowner. I don't know, Sarah, have you been through it yet? Okay. Mm-hmm. Well, it was probably because you got a really great rate, but all those people
did.
Yeah. Those people buying right now that are going to get those high rates, eventually you're going to be in that refinancing position. And that is really cool as a homeowner, because then you get to skip a month of payment, and that is just the best month ever. And then, in what other scenario can you actually realize a smaller payment? When you're renting, that doesn't happen. So as a homeowner, that's another really good advantage, because when you're going to have to figure out how to live with this high payment. But then eventually, I think those rates are going to go down again. And I think we will see rates in the 3s again and the 4s. So, so just because you're buying now where it is at a high point doesn't mean that you won't be able to realize an advantage later. Were you going to say something?
We did get a question that I don't know the answer to. I'm not a mortgage loan officer, so I really don't know what exceptions can be made for that or not. I know that tax records, a lot of that may be a federal requirement, that we collect tax records for past years, but the number of years back really depend on the lender. I know for me, I think I had to provide the past 2 more recent years. So I'm not sure. What I would do is just call different mortgage lenders and see what their requirements are. I'm sorry, I don't have a better answer for that.
Yeah, typically it is 2 years of tax returns that you have to provide.
Yeah, the past 2 most recent.
Mhm. And quick tip for those of you who may not have the best credit score, a lot of people don't, and that's okay. I think that well, I don't know if you guys have thought about this, but I know I did that with my partners. I just put him on my credit card. If you have someone who can add your name as another co-signer on their credit card, if they have really good credit, then you really get to gain that credit history and that score, and it really helps your credit score go up tremendously. So if you have an advantage of a partner, a friend, good friend, family member who can put you onto their credit card, and they don't even have to give you that credit card to use. If they just put your name, your social security numbers attached to it, it helps with your credit almost immediately. So that's my quick tip for people who are experiencing credit issues.
Great. Yeah, and if you have specific questions about your credit, JC very regularly meets with people, helps them pull their free credit reports, look over them, and provide personalized suggestions. So that's a really big thing that we help people with quite a bit, and we're happy to connect with you on that. Okay, so if we don't have any other questions, we will let you go, and hopefully you can enjoy some of the beautiful day outside this afternoon or this evening. Thank you again for joining us, and